Good morning, everyone, and thank you so much for joining us this morning. We have a very exciting conversation planned for today regarding the new Federal Open Market Committee, FOMC, navigating the new Fed chair, Kevin Warsh, and what the new Federal Reserve Open Market Committee means for investors. Today, I will be your moderator. I'm Rachel Hassett, and joining me is my wonderful colleague, Jason J. Hendricks. Jay is a partner and portfolio manager here at Crestwood. And prior to joining us here, he spent some time with Bank of America Private Bank, formerly US Trust. And today he is going to serve as our key speaker. We have a wonderful agenda planned for you today where we'll talk about the Warsh era Fed. We'll talk about political pressure and board composition. We'll talk more about the Federal Open Market Committee rate outlook and consumer confidence versus the stock market returns. And then we'll take some time at the end of today's session for your questions, which you can submit those using the Q&A feature at the bottom of your screen at any point during the call. And as mentioned, we'll spend some time at the end answering those. And then before we get started, one thing, please note that today's conversation is for informational purposes only and should not be used as tax, legal, or investment advice. But to kickstart us off, Jay, let's spend some time on Kevin Warsh. Who is he?
So this is not 2006. He served as the assistant to President George W. Bush, Jr. Bush, for economic policy, as well as being executive secretary to the National Economic Council. In 2006, he was the youngest nominee ever to be confirmed as Fed governor, so at age 35. Importantly, on the Fed during the 2008 financial crisis, he played a very important role in the design and implementation of the emergency lending program that helped stabilize credit markets. During his time on the Fed, he was famous for being one of the only voices ever to warn about quantitative easing and the risk of essentially too loose monetary policy, and that could have an implication in the long run for inflation. He felt so passionately about this at the time that he resigned in 2011 over that issue. After that, he joined Stanford's faculty at their Hoover Institution, teaching at their grad. Also had a long career in Wall Street. He worked at Morgan Stanley, as well as serving on board seats at companies like UPS. So if you think about Kevin Warsh's bio, he has a variety of experience, not only at the Fed during a period of crisis, as well as in academia.
Thanks so much, Jay. So can we spend some time talking about how you'd compare Kevin Warsh's communication style to Jerome Powell, former Fed chair's communication style?
Sure. This chart tells you a lot, right? So this compares Powell's final statement in April to Warsh's incoming statement in June. And you can see there's a wealth of difference in a number of words. So Warsh says that his role model on the Fed he sees as Alan Greenspan, who kept his cards much closer to the vest. In his first statement, he eliminated forward guidance, essentially the text version that translates what the Fed is thinking from the Fed statement. And he dropped the prior language that was in the previous statements about there being an easing bias to the Fed. Remember that the Fed has a dual mandate to both manage inflation as well as employment. And he finished that first statement, short as it may be, by saying that the committee will deliver price stability. And that really tells you where his head is at. So Warsh is more concerned right now about inflation versus what's going on in labor markets.
Thanks so much, Jay. So now what we're going to do is I'm going to read a recent quote from Kevin Warsh, and you're going to break it down for us. So the first one that we have here, before Kevin was confirmed, Warsh had laid out his vision for the Fed in a November 2025 Wall Street Journal opinion piece. And we first unpacked that in our February 2026 market outlook update, which is available on our website. And he specifically said, we're going to read the quote, "The fundamental reform of monetary and regulatory policy would unlock the benefits of AI to all Americans, and the economy would be stronger, living standards would be higher, inflation would fall further, and the Fed will have contributed to a new golden age." What is all of that?
So that's a lot. So unlocked is really the key word there. So Warsh views historical monetary and regulatory policy as having been restrictive. He's a very big believer in AI. He views AI in the same context as other productivity waves we saw in the past, like the electrification of the United States, assembly lines, PCs, the internet. Those things all boosted the growth in the United States. They boosted corporate earnings, and they helped act as a deflationary pressure, keeping inflation down over time. His views aren't necessarily out of step with most economists from that perspective. But what it comes down to is that he thinks that the Fed has been driving the rear view mirror, looking at backward looking data and not accounting enough for how AI and other technologies are likely to boost productivity and act as disinflationary forces. That is a potential benefit to the United States.
Thanks so much, Jay. All right, next one for you. Inflation is a choice.
So this is a bold statement on its surface, but what he's really saying is that he believes that inflation can at times be avoidable. So he argues that inflation isn't always the product of an overheated economy, but also the product of too much government spending and an oversized Fed balance sheet. In that regard, he's not out of step with economists like Milton Friedman, who argued that inflation begins often with a money supply problem, essentially too much money in circulation. This argument does have merit. So large-scale stimulus and an ultra-low rate environment, they certainly contributed to the inflation that we're currently seeing now. And to address this, Warsh thinks we should could be accomplished by reducing the issuance of treasury bills, buying along the curve to basically help shrink it. However, managing that giant balance sheet is really no easy task. So the US has a spending problem. We continually outspend the amount of money that we take in, and Fed borrowing funds programs that keep the economy functioning on a day-to-day basis. As well as if we restricted things like T-bill issuance and we bought along the curve, there's the potential that we can end up with a steeper yield curve. Steeper yield curve means higher costs in things like mortgages, other kinds of consumer loans, corporate lending. It could also mean that the amount of money we have to allocate to interest service on the existing debt we have could be higher. So there's a real debate about how much we could shrink the Fed balance sheet, no matter how much we might want to.
Thanks so much, Jay. All right, last quote for you, which reads, "The Fed's rules and regulations have systematically disadvantaged small and medium-sized banks, which has slowed the flow of credit." Can you break that one down for us?
Yeah, so Warsh believes that easing the regulatory burden on banks of all sizes, particularly small and medium banks, would free up additional credit. So if you think of this conceptually, so more available credit greases the wheels of your economy and specifically benefits small businesses and community and regional lenders. So broad deregulation would support increased lending, increased profitability, which would be a tailwind for things like bank stocks. However, the thing to bear in mind is that all the current rules that we have really, they trace back to real world crises, whether it's the Great Depression, 2008 savings and loan crisis, things like that. And the regulations are there in place to prevent these localized problems from becoming global problems. So just as removing speed bumps and guardrails doesn't make people better drivers, removing or having looser guardrails for banks would mean that potentially we'd have more leverage in the system and weaker overall loan quality.
Thanks for breaking that down for us, Jay. So moving ahead here, the Fed introduced 5 new task forces. Can you talk briefly about each of those?
Sure. So the communications task force would be geared toward how the Fed talks to markets. Less forecasting in words, but more forecasting potentially in data and more usable data for people who actually rely on that. The balance sheet task force is designed to review the Fed's entire $6.7 trillion balance sheet and figure out the appropriate pace for potential runoff to try to avoid that curve steepening we talk about, to try to measure and kind of rein that in. Data and accountability. So Warsh really wants to modernize the data that the Fed relies on. He wants more real time, less backward looking, less slow inputs that we have in the system. The inflation framework, he wants to re-examine how we measure inflation. So the Productivity and Labor Markets Task Force, this could really be nicknamed the AI and Technology Task Force. The idea here is he wants to drill into how modern technology and AI developments would factor into the Fed's read on current inflation and inflation trends, as well as things like wage growth.
Thanks, Jay, which is perfect segue into our next portion of the conversation, which is talking about the political pressure and board composition of the Fed. So can you talk a little bit about the current composition of the Federal Open Market Committee? And in addition to that, bond markets have reacted globally to the possibility of political pressure to the Fed. Can you explain what's at stake there too?
Sure. So there are 12 voters who get to decide essentially at any given point in time what happens with interest rates. So it's broken in the chart into really 2 categories, right? So at the top, you have the 7 individuals, that's the Board of Governors and the New York Fed. And then at the bottom, you have the regional bank presidents. So the regional bank presidents rotate on and off in 1 year sort of votes, right? So they have 5 year terms, but at any given point, there's just 5 voters from the regional bank presidents. The 7 at the top always have a vote at every single rate decision. And the way this is structured is that they have 14-year staggered terms so that no single president can ever really stack the deck. And that's the design that's really being tested. So the Federal Reserve Act requires that governors can only be removed by a president for cause. So Lisa Cook has been accused of misrepresenting information on a mortgage. And the way this works is that the Supreme Court said that someone can only be removed from the board if they have done something for cause, meaning there has to be clear evidence of either inefficacy and neglect of duty, malfeasance, something like that. And that none of the people on the Supreme Court are at-will employees. So a president can't simply remove them for the accusation of potentially having done something wrong, or if they're not acting in a way that the president likes. That said, it doesn't mean Lisa Cook is in the clear. It simply said that the court ruled that has to show that there's some sort of evidence. She has an opportunity to respond to that. It doesn't mean necessarily she won't be ultimately removed. If she is removed, the president would gain the ability to appoint a replacement to the Board of Governors. That person would likely be Stephen Meron, we'll talk about in a moment. But the simple possibility that the president or an administration could influence the Fed and potentially at their discretion, that causes the perception of sort of instability or uncertainty. And any kind of uncertainty makes investors very nervous because they want a slow-moving, a deliberate, a thoughtful Fed that's making data-driven decisions, as opposed to potentially a Fed that could be influenced by whoever's sitting in the White House at any given point in time. It's worth noting, by the way, that we broke this down for you between hawks and doves. So hawkish Fed voters are people who that's the people with the red bars. People who have historically voted for higher interest rates or been willing to have higher interest rates. Dovish voters, represented by the blue bars, are people who have historically been in favor of lower interest rates or easier conditions. And if you look at the 2026 voting column, you note that there's definitely a dovish bias. So 6 of the 12 FOMC voters in 2026 are dovish. In 2027, because the 3 hawkish voters rotate out from the Reserve Bank presidents, and that would give the remaining voters in 2027 a notable dovish bias. And it's important to think about that they're starting from a perspective of potentially favoring easing from their historical pattern when you think about what the data they're seeing now is and how they've adjusted their expectations.
Thanks so much for the context there, Jay. Very, very helpful. And so moving ahead here, we're going to talk about the FOMC rate outlook. And on this next page, June CPI number was cooler than expected. Does that mean that we're out of the woods in terms of inflation?
No, absolutely not. I wish I could say we were. So June here, that's the largest monthly drop we've seen since April of 2020. And that's largely driven by energy prices falling as the war was anticipated in Iran seemed to be winding down or seemed to be, instead of heating up, it seemed to be cooling a bit. If you strip that out, right? So the gold line on the left shows the headline number. The blue line beneath that shows the core. Core strips out the more volatile energy and food prices. So you can see that stripping out the impact of energy, that core line barely moved. It cooled a little bit, but not that much. That's not really the indicator, though. CPI isn't the thing that the Fed favors. It still has utility. It's used for things like the inflation adjustment to Social Security. But if you want a better, more comprehensive gauge of inflation, the Fed really favors PCE, so personal consumption expenditure. And as you can see, just comparing those two lines, now the data from the PCE is 1 month delayed. We're not going to have an update to that to the end. Essentially, the Fed concludes, but realistically, it does not move anywhere near as much. So CPI is a much more volatile measure that swings from month to month, and that's one of the reasons the Fed prefers that as their gauge of inflation.
Thanks so much, Jay. So can you tell us the difference between PCE and CPI?
I'd love to. All right. So easy way to think of this is the CPI is a fixed basket of goods for urban consumers. It is very different than PCE. So PCE is designed to capture all the household consumption. That includes things that are spent on your behalf. So for instance, if you have employer-sponsored healthcare, if you're on Medicare or Medicaid, that gets captured in PCE, but it would not be captured in CPI. And very importantly, it uses a different methodology to capture spending patterns. So where CPI uses a fixed basket, PCE captures the fact that like if beef prices are high, you stop buying beef and you switch over to chicken. That'll be captured in essentially the change of your spending patterns. It is a much more balanced approach to capture actual how people spend. It has less of a weighting on shelter as a metric. So about half the weighting in PCE versus CPI. Shelter is a hard thing to capture accurately. It's sort of a trailing measure of rent. And many people think it's underrepresented in inflation. Last thing, essentially, that CPI is fickle. It moves very much from month to month, but PCE is much slower moving. That's notable because if you're writing articles, for instance, if you're in the media, you want something to talk about, you're going to talk about CPI numbers. You're less likely to talk about PCE numbers, which might move 0.1% or 0.2% from month to month.
Thanks so much, Jay. So moving ahead here, considering the war in Iran and how the economy has evolved, how has the Fed's view on rates changed?
Yeah, so quite a bit. So what you're looking at here is the statement of economic projections, the Fed's dot plot. So each of the gray dots you see for how they see rates changing over time. And the gray line you see is the median of those dots. And if you compare that to December, the gray dots, to the green dots in the green line, which is June, you can see a distinctive trend difference, right? So the Fed is really projecting higher rates for longer. Now understand this is their forecast. This is sort of their expectation. It's not a guarantee that where rates will be. However, it's an indication of what they're thinking. And what they're saying essentially is that we're concerned about inflation. We see that there's potentially a risk here. Now, in both cases, the December projection and the green projection, you see, in the longer term, they're at similar points. But the Fed is saying we think it could take time, a longer period of time, before we get to those more favorable rate environments. And it's certainly a possibility based on their projections that we could actually see a rate hike before we see a rate cut. And for those folks who have really good vision, you can actually see in the bottom left that there are these little gray outlier dots. Those are actually Stephen Mirren's votes. So Stephen Mirren was temporarily on the Fed. If Lisa Cook is eventually displaced from the Fed, Stephen Mirren, in all likelihood, is who would actually take her place. And you could see just based on his voting pattern that Stephen is very much likely to favor lower rates, so quite a bit lower than pretty much everyone else. So if he was on that chart we had showed previously, the Hawk Dove chart, you would see his blue bar would go far to the left, perhaps even off the edge of the page.
Thanks, Jay. Now, where does Wall Street and the major banks think that the Fed is headed?
So the honest answer is that no one really knows for certain. So Bank of America, for example, went from in June saying no rate hikes this year to potentially 3 rate hikes this year. Deutsche Bank is projecting 2 rate hikes. JP Morgan, Morgan Stanley, and Goldman all saying that for 2026, the Fed is likely to keep rates steady. There's really no consensus among Wall Street about what's going to happen in 2026. Importantly, too, the futures markets have consistently gotten this wrong. So anyone who's looking at the percentage odds of the Fed doing a certain thing at a certain time horizon, it is a terrible indicator. But Warsh has told us something which is pretty important. So when he testified to Congress on July 14th, he said there might be some that look at this morning's data and say mission accomplished, but that is not my view. And so even though Warsh himself didn't submit a dot for the plot, you can see that he is more aligned with what the other Fed governors are saying, that they do think that there's certainly a potential for higher rates before rates come back down again.
Thanks so much, Jay. All right, so let's take a minute to talk about consumer confidence, which seems to be falling even though the stock market has been trending upward this year.
So this is a question we get a lot about what's the connection between consumer sentiment and stock market returns. So academic studies find a positive but modest correlation between the two things. So one study put the correlation around 0.56. That tells you it's not a particularly reliable indicator of stock markets, certainly not a one-for-one, but it is worth noting that it's something that you could think about as potentially a contrarian indicator, which we're going to look at on the next chart. All right, so as I said before, their studies show that there is a connection between the two, but it tends to be that stock prices actually lead consumer sentiment. It's not the other way around. So consumer sentiment is peaking, then the returns that tend to follow are lower. And when consumer sentiment is lower, the returns that follow tend to be higher. However, the peaks and troughs happen at very different levels depending on the market environment. So the average over time, as you see that dotted blue line, is about 77. But at peak, before in certain market cycles might be at 85 or it might be at 105. And likewise, troughs tend to be below 50, but they could be in the 60s or even the 70s. Sentiment today is on the low end, so it's below 50, which is one of the reasons we think people should be cautiously optimistic about the market. But why is there such a disconnect right now? Well, that really comes down to the fact that when you think about the cost of your rent and when you think about the cost of things at the grocery store, you are seeing the real world impact of inflation, right? You really feel it. And that makes you feel much more pessimistic than the stock market, which is looking ahead of things, is looking at things like expanding margins, growing corporate earnings, and being more optimistic about things. But it's very hard to be super optimistic, right? If beef costs twice as much as it did yesterday.
Thanks, Jay. So some investors have talked about the possibility of Iran causing stagflation and where we have rising unemployment combined with rising inflation, like we had in the 1970s during the last oil crisis. What do you think about that?
So it's the good news is not the 1970s. So inflation is trending by any metric, so much lower than it did in the 1970s. Unemployment by various measures is still low. So unemployment over time averages about 6.2%. By any measure, we are significantly below that. In general, if you hit an unemployment level of 5%, most economists want to jump out of a cake. However, measuring unemployment is actually tricky, right? So right now, the labor force participation rate has dropped down. And that's partly because of baby boomers retiring and some people staying out of the labor markets for longer. So one of the things that Warsh wants to focus on is getting a better read on that so they can really get sort of pinpoint exactly where we are. But by any measure, it's lower, significantly lower than when it was in the 1970s. And likewise, when we think about inflation, so inflation now by any metric is about a third of what it was during the hot 1970s. So it's much, much lower than what it was. But something to bear in mind is before he left, Powell about 6 months ago had a line that said, we're in a low hire, low fire environment. And that comment really still holds true. So hiring remains healthy in certain segments of the market, like healthcare, some social things, professional services. But that said, employers did add fewer non-farm payroll jobs at the last labor report, and much fewer than economists had been expecting. So there is certainly concern, right? But we're not at the point we were in the 1970s. One of the ways to think about where we are economically is the misery index. That simply adds in the inflation number and the unemployment number and combines them into one. And when you combine those things, that measures essentially how many people are struggling to afford things on a day-to-day basis, as well while also being kind of out of work. And the number where we are now in the misery index is less than half of where we were in the 1970s, so significantly better. Likewise, from an energy dependence perspective, in the 1970s, we were far, far more dependent on foreign oil than we were now in the United States, where we're a net exporter of petrochemicals. So the global energy supply chain is better diversified now than it was in the 1970s. And lastly, a really, really important point to distinguish, right, is the difference in the Fed composition. So in the 1970s, the Fed was very slow to raise rates. And it didn't really pick up pace until Volcker comes along and shoots rates through the moon. And because of that slow to act sense, people got it sort of in their heads as a economy that inflation was out of control, the government couldn't really do anything. And as a result, that sort of gets into the psychology. People feel like prices are going to keep going up. I need to keep asking for a higher wages, and inflation gets into an ugly cycle. By contrast, the Fed of 2026, both under Powell and under Warsh, when they see signs of potential inflation, they immediately move to say, hey, we should think about raising rates. We're not certainly thinking about cutting rates at this point in the cycle. So right now, the Fed is in a much more hawkish position, even though they have the voters, right, have a dovish bias, but they're still more of a hawkish position than they were in the 1970s. So what the Fed now is really saying, we see sparks and there's dry tinder. And what we want to do is stamp out those sparks, hopefully, before it turns it into a bigger flame, and then we have a runaway problem.
Jay, thanks so much. Really appreciate the context there. Now, before we pivot the conversation and open up the floor to Q&A, which, as a reminder, folks, you can submit those questions using the Q&A feature at the bottom of your screen. We'll get to those in a minute. Jay, would you mind just running through the key takeaways from today's session?
Sure. So expect less forecasting, not less action from the Fed. And that means that Warsh's statements are likely to be much shorter than Powell's, but investors should definitely pay attention to voting trends and changes in the FOMC. So the dot plots, how those are sort of evolving over time. That's not a, again, exact predictor of what the Fed is going to do, but it gives you an indication of the, what direction they're leaning in based on what the data is that they're seeing. Second, watch what the Fed does, and don't watch as much what Kevin Warsh is saying or probably not saying. Warsh is unlikely to telegraph his personal beliefs, but based on his past actions, he is unlikely to advocate for cuts if the data doesn't support it, and would likely advocate for higher rates if PCE number doesn't improve. So if we still stay in this sort of inflationary environment, we're more likely to see Warsh advocating for higher rates than to him say we should cut in any case. Third, I would say, focus on PCE, not CPI. You'll see a lot of print about CPI, but don't read too much into changes of CPI. So in all likelihood, with oil prices starting to tick back up, we're going to see a higher CPI print in the months to come. But really focus on the slower moving PCE trends as a sort of forecast of what the Fed is likely to do over time. Lastly, don't conflate consumer confidence or consumer sentiment with stock market trends. A divergence between the two is very, very common. Instead, we really recommend that people focus on fundamentals. So focus things on revenue growth, earnings growth, cash flow, margins, much more than sentiment. And if I could teach everyone just one simple math equation, it's that fundamentals are greater than feelings. So focus on the fundamentals. Don't get caught up in the sentiment and the headlines.
Love that. Fundamentals are greater than. Awesome. Well, Jay, thank you so much for these insights. Very, very helpful. We are going to pivot the conversation and open it up for our questions. We did get a couple pre-submitted client questions, so I'm just going to kickstart us off with one right here, which is why is consumer sentiment so low if the economy is so good? Have we ever seen this before?
So the answer is yes. So you can end up with a divergence. It's an unusually wide divergence right now. And that's partly because, again, when people think about their rent, the rent has gone up dramatically, double digits in many places on a year-over-year adjustment. At the same point in time, you're seeing affordability challenges at the grocery store. And even though wages have gone up, they haven't really kept pace with what's going on. So that all hits consumer confidence. You don't feel as good about things if you're essentially not feeling the wealth effect when you go to the grocery store. The one thing that does discount, though, is that when you see real estate prices going up and you see there's a challenge to home prices, over 60% of Americans actually own homes. They have actually seen the wealth effect in their balance sheet, but not necessarily the wealth effect that shows up when you go to the grocery store, right? So there's definitely a disconnect between those two things. It's not uncommon to see that, but this is a particularly sharp period of time.
Awesome. Thanks so much for taking that one, Jay. Another one that we had come in is what about the Fed's balance sheet? $6.7 billion. Like, how will they unwind this?
So that's trillion with a giant capital T. So 6.7 trillion. It is a giant number. So the short answer is they would look to essentially manage the pace of runoff or effectively not renew. So as in you let a bond mature, you don't go back and ask for more money in the future. You trim the amount of treasury bills you decide to issue at a given point in time. It is trying to like steer a cruise ship with a canoe paddle. It's very difficult to actually slow down the pace of that. And it requires a mixture of really two things. So the Fed certainly has an appetite to control the amount of debt on our balance sheet, but you also need congressional action. So Congress controls the purse. So Congress would have to basically be willing to cut back on some of our spending while we're controlling the pace of essentially our borrowing and our issuance, right? But those two things are really, really challenging. So we would do it gradually. One of the reasons Warsh is advocating for having a task force to look at this, it's no question of should we do it. The question is, can we do it at this point during the cycle, or do we have to make other structural changes to make that a reality?
Thanks so much, Jay. Next question kind of feeds off of that, which is what about the government deficit? Like, how does the Fed affect this?
So again, short answer, the Fed would love to shrink the deficit. And no one really knows how long we can keep outspending our income. We've been doing this for a very, very, very long time. The short answer is the more deficit you have, essentially the more you have to borrow. The more you have to borrow, the more you have to have an interest service cost. And we've been spoiled for a long period of time by having really low interest rates. So the cost of ballooning the Fed's balance sheet was something we could afford to do for a while. However, those chickens are coming home to roost. The reality is that when we borrow today, it is very different than when we were borrowing during a zero interest rate period, right? So one of the things we need to do is basically start to limit the ability of our borrowing. And that's going to take time. So the Fed can only manage this. They can say, hey, this is a real challenge, and we can look to try to manage along the curve to control our interest rate costs, but we can't basically control it down to a pinpoint. That really has to start with Congress and then shift over to the Fed.
Thanks so much, Jay. Looks like we got a pre-submitted question in the chat, which is that Mark Anderson, who is a big advocate for crypto, is also an advisor to March. And so what do you, so the person had mentioned that they have read that the stablecoin market is a new market for treasuries. What do you think the Fed is thinking about this? What implications are there?
So great question. So the current administration has now embraced crypto. So if you rewind the clock just a few years ago, we were working on a CBDC, a central bank digital currency, a digital US dollar. We have now shifted away from that after literally one of the first things we did within 6 months is saying, hey, we're not doing a central bank digital currency, even though other central banks around the world are chasing this same thing. So a stable coin effectively opens up an appetite to hold treasuries. They're essentially going to, they need something that is pegged to a stable value. It's pegged to something like the dollar, and it can be used as an alternate version of short-term liquidity, aside from just the normal treasury markets. The answer is that you're going to see increased adoption of stable coins over time. Now, this is a Wild West market. And let me stress this because it's not like we have just one stable coin to choose from. And they all have similar merits, similar arguments, and things like that. So it's really hard to pick, let's say, which one is going to be the stable coin that lasts for 5, 10, 15, 20 years. But certainly you're going to see speculation here. And this is the thing to bear in mind. Because you have an environment where it's a new frontier, and we have a less of a focus on regulation, you will see many of these things come and go on a regular basis. So picture there will be many fortunes made in the crypto markets, even chasing stablecoins, many fortunes lost in the crypto markets. For those people who are thinking about investing in these, I would tread really cautiously, right? So we're still in the early days, and this is the Wild West. You are just as likely to get shot in the back by a desperado as you are to find a gold nugget.
Thanks so much, Jay. All right, so another question came in. The Fed is often wrong, and why do we pay such close attention to everything that they say?
So this is a popular question. It's not necessarily that the Fed is wrong, right? So that people some economic projections, a dot plot, and say that's where we're headed. That's absolutely where we're going to be. So the Fed is data dependent. They're trying to become over time even more data dependent, just more current data dependent. So that's saying we should change our mind and change the directions based on, like, if you're driving, as the road conditions change, right? So if you're driving along, it's a clear sunny day, it starts to rain, you're going to slow down for how quickly you are, going to flip on the wipers, hopefully turn on your headlights, worry about other drivers. You're going to change your conditions. You might say, hey, I'm going to meet you for dinner in an hour, but if it starts being a pouring rainstorm or a hailstorm, it's going to take you a little bit longer. And the dot plot is an evolution of that. It's not that your original assessment was wrong, that you're not going to meet the person for dinner, right? It's just that conditions changed over time. So that's what we should continually expect, right? So the Fed gives us a window into what they're thinking. The Fed doesn't give us a promise that's going to deliver a certain rate at a certain time, and it's going to do that.
Thanks so much, Jay. This is super helpful. And thank you so much for being here and for sharing all of your wonderful insights with us today. This was a really great conversation. For those of you who are tuned in, thank you so much for being here. We really appreciate it. If you'd like to dig in more, we recently published our market and economic outlook, which is available on our website. Please take a peek at that. The replay from today's call will also be available at a later point up on our website. But we really appreciate you being here, and we hope you have a wonderful rest of your day. If you have any other questions for Jay that we didn't get to, please submit those to your team, and we will happily answer those offline. But again, thank you all for being here today. We really appreciate it.